You're listening to Nora and Noah Decode the Day, where markets meet meaning every morning.
Welcome to the Deep Dive. Today, we're tackling a really big question, one that's definitely been on people's minds. How are the huge U.S. tech companies, the ones that dominate the S&P 500, how are they actually dealing with President Trump's shifting trade policies?
Yeah, it's been a major point of uncertainty.
So we've really immersed ourselves in their latest earnings reports. The idea is to give you a clear sense of what's really happening, what it might mean for the wider market.
And hopefully do it without getting bogged down in too much financial jargon. Just the key takeaways.
Exactly. So let's set the scene. Before these earnings came out, there was quite a bit of anxiety, wasn't there?
Oh, definitely. You could feel it among investors. The worry was that, these tech giants would start reporting real problems because of the trade situation, potential tariffs.
Right. Fears of these policies would seriously hit their profits, their growth, maybe a worst-case scenario brewing.
Precisely. That was the backdrop. A lot of nervousness about what these reports would reveal.
Okay, but then the reports started landing. And the market reaction was, well, it seemed quite different, didn't it?
It really did. We saw a pretty significant positive reaction. The NASDAQ 100 index, which is packed with these tech names, it jumped a full 10% over 2 weeks, which is, it's substantial.
10%. Wow. And that put it above where it was before the latest tariff talk really heated up?
That's the interesting part, yeah. It ended up about 3% higher than its level back in early April, right before those concerns spiked again. And you saw specific names do really well. Microsoft, for instance, had its best week in more than 2 years.
So some real relief there. Maybe the market is getting a bit used to this volatility. Or maybe the companies are just getting better at handling it.
It could be a bit of both. There's certainly an element of these giants becoming more, let's say, adaptable, but the reports themselves also seem to fuel that optimism.
All right, let's get into that. Because it wasn't just, phew, not as bad as feared. There seemed to be some genuinely positive signals coming directly from the companies about their actual business performance.
Yes, that's key. Looking at the outlooks and forecasts from big players like Amazon and Microsoft, they were generally pretty strong.
Suggesting demand is holding up?
Exactly. Demand for, electronic devices, cloud services, software, even digital ads. It seems largely solid, at least for now. The core growth engines haven't stalled.
You mentioned Microsoft having a great week. What specifically stood out in their report, particularly their cloud business?
Yeah, Microsoft's revenue forecast actually beat expectations, and a huge part of that was Azure, their cloud computing arm. It's just incredibly strong.
Strong how?
Well, demand is so high, it's still outpacing their ability to build out data centers fast enough, which, is a pretty good problem to have, signals real market strength.
Okay. Now, Amazon.
Okay.
I remember that being maybe a bit more of a mixed bag.
A little bit, yeah. Their operating profit outlook for the next quarter came in slightly weaker than some expected. But, and this is important, the CEO, Andy Jassy, he specifically said they are not seeing any signs of demand weakening right now.
So profits might fluctuate quarter to quarter, but the underlying customer demand seems okay for them.
That was the message, yeah. Crucial for gauging overall consumer and business health.
And what about Meta? The digital advertising market is always a big focus there.
Meta's forecast for ad spending was reassuring is probably the word. It basically lined up with what analysts were already expecting.
So stability there. No major red flags.
It suggests that key revenue stream is holding steady for now.
Okay, another big worry point for investors was capital spending, right? Especially with all the money pouring into AI. Were companies going to pull back?
Right, that was a concern. Would they cut back on buying all that expensive AI computing gear?
And?
Well, those worries seem to ease quite a bit. Meta actually increased its forecast for capital spending this year.
Increased it. So doubling down on AI infrastructure.
Seems like it. Investing in the hardware, the data centers. And Microsoft, while they suggested the growth rate of their spending might slow a bit next year, they still expect to keep expanding.
And that had a knock-on effect.
It did. Chip makers, hardware companies, their stocks got a nice boost from those comments. It signaled continued demand for their products.
So lots of positive signs, relatively speaking. But you did mention earlier Apple was a high-profile disappointment. What happened there?
Yeah, it's really important to stress this wasn't universally positive news. Apple stood out.
Why?
They specifically called out expecting about $900 million in higher costs just in the current quarter, and they tied it directly to tariffs.
Ouch. $900 million. That's significant.
It is, and following that, they got hit with downgrades from at least a couple of Wall Street analysts.
Citing the tariffs.
Citing the tariff headwinds, yeah, but also some broader concerns about their growth outlook.
So Apple's situation really highlights the vulnerability, especially for companies with big hardware businesses and complex global supply chains.
Exactly. It's a reminder that while some tech sectors seem okay for now, others are definitely feeling the direct impact of trade policy, and that could potentially ripple through other industries too.
And Apple wasn't the only one showing some strain, was it?
No, that's right. Tesla also backed away from a previous forecast. They had suggested they'd return to revenue growth in 2025, but they walked that back a bit.
Okay, so some specific company issues.
Right. And just the general risk, The trade situation is still very much ongoing. Market volatility could flare up again.
And we don't really know the full impact of the tariffs yet, do we? Not until the next set of earnings, perhaps.
That's a fair point. It'll take time to see the complete picture unfold in the actual numbers.
It's interesting, though. We're seeing these tech giants largely hold firm or even raise forecasts, but that's not happening everywhere in the economy, is it?
No, definitely not. It's quite a contrast. You look at other sectors, airlines, shoemakers, various retailers, and many of them are actually pulling their forecasts.
Pulling them entirely.
Yeah, or becoming much more cautious about spending. It really highlights how uneven the impact of all this economic uncertainty is across different industries.
So if we try to zoom out again, bring all these threads together, what's the main story for these big, magnificent 7 tech stocks coming out of these earnings, especially with the trade policy cloud hanging over them?
Well, the big picture, connecting the dots, is this. While profit estimates have been coming down in many other S&P 500 sectors,
Right.
the projections for these top tech companies are actually going up.
Going up, even with everything going.
Even with everything. Bloomberg intelligence data, for example, shows expected earnings growth for the Mag 7 is now pegged at 21.6% for 2025.
21%? Wow.
Yeah. And revenue growth at 9.7%. And crucially, both of those numbers have actually been revised upwards recently.
That is a significant divergence from the rest of the market. What are some of the experts saying to make sense of this?
Well, Mark Luschini over at Janney Montgomery Scott had an interesting take. He basically said that even where the numbers were a bit weak, they were still better than the really dire scenarios investors had been bracing for.
So relief played a big role.
It allowed the market to take a sort of glass half full view, he argued, even though the uncertainty hasn't vanished. Like bracing for a hurricane and getting just a bad thunderstorm instead. Still rough, but manageable.
Okay. And I think Hannah Howard from Gabelli Funds had a point about why tech might be holding up there.
Yes, exactly. Her perspective was that these tech companies have earned, let's say, more leeway to spend.
Leeway, because they deliver.
Because they've shown they can deliver returns, they can support growth, so maybe investors are giving them more benefit of the doubt on continued investment, even in uncertain times.
Makes sense.
She basically summarized it as, look, concerns about things getting worse are still out there, absolutely. But the overall picture from these earnings reports was pretty positive.
Okay. So wrapping this up then, it feels like the main takeaway is, despite all the anxiety about trade policies, these recent tech earnings suggest more resilience than maybe people feared. It provided some reassurance, calmed some nerves in the market.
That's a fair summary, yes. But it's crucial for you, the listener, to remember that this isn't a completely clear all systems go signal.
Right. Not out of the woods.
Definitely not.
Yeah.
Challenges remain. Uncertainties are still very real. Apple's specific issues are a perfect example of that, and the whole trade situation is far from resolved.
So caution is still warranted.
Absolutely.
And maybe that leads to a final thought for everyone listening. If we look beyond just these immediate trade issues and the latest earnings cycle, what other big forces might really shape the long-term future for these tech giants? Things like, the next wave of innovation or major global events we haven't foreseen, or even fundamental shifts in how we all behave as consumers.
Yeah, what are those deeper currents? That's definitely something worth mulling over.
Indeed. Well, thanks for joining us for this deep dive.
That's it for today's Decode. If you found this helpful, make sure to subscribe, and we'll catch you tomorrow, right here on Nora and Noah Decode the Day.